Welcome back to my 20 time project, and again I will be going over investing in cryptocurrencies and foreign exchange and the type of topics. The topics that we have today are: what is a trend, support, resistance, and trend line, drawing support, resistance and trend lines, price reaction, pullbacks, your trading window, confirmation checklist, and your trading plan. So first, what is a trend? A trend is the overall direction of which the market is moving. If it is going up, this is called a bullish trend. Down means it is a bearish trend. Learning a trend helps the traders to know when to buy in an uptrending market and when to sell in a downtrend market. The trend has to have a few certain features. Anytime a bull trend starts, it starts at a low point and makes a high point in the market. If it makes a low that is higher than the last one, it is called a higher low. Same thing applies for the highs. If they continue to grow higher, then it is an uptrending market. And if it goes from a high to a lower high or a low to a lower low, then it is a downtrend inside of the market. Every trader should make sure to practice and try to trade with the trend. Our next topic is support, resistance, trend line, also known as SRT. These make points where the market can potentially react in the market and reverse. The psychology of an SRT has parts to it. We first have the floor, where the market gets its first lowest low. Then it has a ceiling where the market goes up, then hits a point, then tries to hit it again and goes back down, then hits that same spot again and goes down. Finally, it will eventually go back up. This also is known as a resistance. It will begin to go up and make a higher high and create a new resistance when it does go and make a new high. The old new becomes the new floor, which creates another support. If you look at it like a river, you would kind of think about it like this. When a river hits a rock, it changes currents, causing it to change, and then if you hit another rock, it changes the same thing. That is basically what a ceiling and floor do. They help create a price change in the market. Supports help the price from not going more below that line. These are all very important features to price trading actions. Ceilings and floors are almost the same thing. These show traders when to buy and sell in the market before they make downtrends. Prices, when they grow up as a whole, become a uptrend, but when it hits resistance and starts to make a complete reverse and moves the entire market down, it is known as a downtrend. Prices will continue to react with uptrends and downtrends within the market, reacting to either lower prices or higher prices. Sometimes they will make upward trends and make straight line formations until they go completely up into resistance and make a new downtrending formation. The next topic is drawing support, resistance, and trend lines. This helps with becoming a better trader. This plays a major part in affecting prices. It is important to know them and know how to draw them and know the rules of engagement. As we already know, the support is also known as the floor and the resistance is known as the ceiling. The market is all about creating different motions like swing lows and swing highs. Those are the low points and high points on the graph of the price motion on the currency. There need to be at least 2 points of the price rejection for a support line to form. This allows us to know that if we invest, we have a higher probability that the price will not go below the point. The same thing has to apply to the resistance or the ceiling. There have to be at least 2 points where the graph hits and resists back. When making a trend line, you have to try and connect the candle points or the max and mins and try and figure out the average slope of line. Sometimes we would have to start from the origin to make 2 trend lines for the same uptrend to try and connect all the dots. The third point is usually the best point to expect a reaction. When trying to invest, we should try to invest when it hits back at the origin or floors. The third point usually causes the third major interaction with the resistance, which caused a bigger reaction coming down. This, of course, applies to low trends or uptrends. You can use these skills by going really close to the graph or even zooming out really far. So, our next topic will be price reaction. This is how traders read and interact with the graphs inside the market and get a better understanding of where prices are going and where prices could potentially go up, and can identify good opportunities to buy and sell. The market moves in three main different ways: up, sideways, and down. The market creates data points. These are swing lows and highs, and these make these three directions. You should always connect them to find the direction and get a better understanding. You can make points on the highs and lows to eventually connect the dots to find the directions. Our next topic is pullbacks. The direction are important to this concept, and so are the different trends. For example, there is an uptrend. In an uptrend, that means that each high and each low is higher than the one before. We also know that there are floors that cannot be passed. So we all know that money cannot go up forever, and that sometimes it will hit a ceiling and come down. That is what is known as a pullback. When the price action gets resisted and gets pulled down, even though the entire trend is going up, there are still prices that go down. This can help you as a trader to help understand whether or not the chart will continue to go up or will it go down on a trend. The next topic is your trading window. Your trading window is a combo of your balance, equity, margin levels, and is how a trader keeps track of your money. The balance is the amount of money you have in your account that is not currently being used. Equity is your balance plus your floating profits or losses. The free margin represents the money you have available in your account to trade with. If all your trades are closed, your free margin will equal your balance. If you have open trades, your margin will be below your balance. Your margin level is the ratio of your equity to your margin. The higher you margin to level, more margin you have available to trade. If the margin goes to 100%, that means that you are not able to open any more trades. If your balance is really low, the app will automatically close all of your trades. This is called getting margined out. The margin is the amount of money needed to open a new broker. Next, we have our confirmation checklist. In order to minimize our risk, we need to maximize our confirmations. This would allow a trader to enter the market and potentially make some money. The first confirmation is trading with the trend. If it is going up, we should buy. If it is going down, we should sell. Best places to buy is at the trend line. Our second confirmation is to know whether we should buy or sell at low and high points. Essentially, are we buying at support and selling at resistance? Buy low and sell high. The next confirmation we should be looking at is if the market pulled back. Did it break and retest? Meaning, the market went up and broke its previous resistance and then created new support inside the market. The market is always breaking and retesting. The next confirmation is done. The market exhaust. This basically an imbalance in power that causes buyers and sellers to keep pushing it either more up or more down. A bonus confirmation is, did the market break a previous high or low? This helps us with figuring out if it would become a high or low trend. Your trading plan is our next topic. A trading plan is an organized approach a trader has when executing a trading system. Before you begin to trade, you should know what to do with your selling and buying ability in order to gain as much profit as possible. The first part is your mindset. You should always be sure you are comfortable in everything around you, because if not, it could distract you and cause you to do a bad trade. And this is important because you must remember that trading is 90% mental and 10% technical. Then the next step is to plan your trading style. We have to know if you are preparing for a technical approach or fundamental. Are we going to be looking at price action within the charts, or are we going to be looking at fundamental news to see what will be affected and how or will you put them together? The next thing to worry about is which session are you going to work in. Next is what pairs are you going to try and master in. Are you going to do the Great British Pound to the US dollar, or maybe the Euro to the US dollar, etc.? The sixth is time. You have to plan when you are going to trade. Like, for example, doing it during the time it opens is very risky because that is very unpredictable time. The seventh topic to plan is your ideal setup. You should have an ideal setup and ideal analysis before trading in the market. This is something that you see over and over again to have more confidence in the setup. Next, you should have a compound plan. This allows the trader to get three main things. The first is the number of pips they want. The next is the number of trades you take per day and how many trades you want to open at any time. Lastly, it is the percent per day that you want to make per day. The next thing is to have a money management plan. This has two aspects. Do not let a winner turn into a loser. Whenever you enter a trade, move a stop loss to your advantage. And part 2 is learning how to trail your stocks. Part 2 to the money management plan is to learn never marry a plan. Learn how to cut your trades within the market. Because if it does not go your way, you could lose a detrimental amount of money in your account. Lastly, for this topic, you have discipline. You should have the adequate discipline to not only make a trading plan, but also stick to it. Thank you for watching, and please let me know if you have any questions.